Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Wednesday, May 3rd, 2023. Two U.S. congressmen have written a letter to the chair of the Council of Economic Advisors. In this letter, they demand an explanation for a chapter the agency prepared for the Economic Report of the President. That chapter expressed a, quote, hostile view toward the digital asset ecosystem. And you know what's remarkable about this? These two representatives are Alexandria Ocasio-Cortez and Matt Gaetz. These two are not known to agree on all that much. To see them work together on this is remarkable. This report was presented to Congress in March. It contained a chapter titled The Reality of Crypto Assets that claimed such assets have brought none of the promised benefits. This is a big difference from the agency's position in the president's executive order on ensuring responsible development of digital assets. This letter raised questions, many of which came from crypto supporters who objected to the claims made in the report. The writers ask how firms can be expected to comply with the law when the laws that allegedly apply are conflicting. For example, when a product is considered both a security and a commodity. They asked why they dismissed the role of Congress by saying much of the activity in the crypto space is covered by existing regulations. Yeah, because it's not. Quote, is it the CEA's view that the legislation from Congress will not mitigate potential risks and provide consumers with more protections than exist today? Finally, they demanded to know why the agency claimed that the soon-to-launch FedNow instant payment system and central bank digital currencies would make things simpler and more effective than digital assets when it comes to upgrade the financial system. AOC and Gaetz set a May 26 deadline for the answers. Now, in other news, the Biden administration has proposed a punitive tax on crypto mining operations. And there's no other way to describe it other than punitive. This tax would equal 30% of a firm's energy cost. Now, clearly, it's intended to discourage crypto mining due to its environmental impact. The tax has been met with opposition from the crypto industry, which argues that it would be unfair and that it would stifle innovation. I don't think it's going to happen, though, because it would need to be approved by Congress. That said, this is a terrible idea. It's unfair, it's harmful to the industry, and it will cripple financial innovation. First of all, the tax is unfair. It would disproportionately impact small miners, because small miners are less likely to be able to afford the increased costs. Make no mistake, this is intentional. The Biden system wants to protect the grotesque central bankers and their ghoulish banking system. They want to avoid competition from crypto at all costs because they know a direct, fair comparison is one they cannot win. Second, the tax will harm the industry. It will make it more expensive to mine crypto, discouraging investment and innovation. This will hurt the entire crypto ecosystem, and it will ultimately hurt consumers. Third, this tax will cripple financial innovation. Crypto is a new, innovative technology. It has the potential to revolutionize the entire financial system. The Biden's administration tax will put a bullet in its head. It will stifle innovation, and it will make it harder for people to access financial services. This tax is a bad idea. It's unfair, it's harmful, and it's unnecessary. And we need to pay close attention to any idiot that votes in favor of this bill. And then we should work tirelessly and devotedly to ensure that they never set foot on Capitol Hill again. The future of crypto regulation in the United States is uncertain. The Biden administration has taken a more hostile approach to crypto than the previous administration. That said, it's unclear how far this administration is willing to go in regulating the industry. Congress is also divided on the issue of crypto regulation. Some lawmakers think that crypto should be regulated like other financial products. Others think that it should be left unregulated. Now, Congress may eventually pass legislation that regulates crypto, but it is also possible that the industry will remain largely unregulated. In fact, unless something changes the balance of power in Congress in 2024, I suspect this situation will go largely unchanged, at least on the regulatory front. The outcome of this debate over crypto regulation will have a significant impact on the future of the industry. If crypto is regulated too heavily, it will stifle innovation and growth. However, if crypto is left unregulated, it could pose a risk to consumers and the financial system. And here we are at tonight's cover story. But first, I want to ask you to like, follow, and subscribe to the podcast. That way, you can help me in reaching more listeners. So thank you. And for tonight's cover, crypto exchanges Binance and Circle submitted feedback to the UK government on proposed crypto regulations. Binance is the world's largest crypto exchange by trading volume. They said the government should strike a balance between protecting consumers and innovation. Binance warns that disproportionate regulation could stifle innovation and growth in the crypto industry. Now, Circle said that the government should make the registration process for digital asset firms simpler and more transparent. They called for more clarity on the distinction between crypto asset activity and activity related to payment stablecoins. The UK's consultation process comes as companies have accused the US SEC of dragging its feet on providing clear rules for the crypto sector. It seems like every day the US is falling farther and farther behind Europe, at least on crypto regulations. The UK government also plans to ban cold calls to sell financial products, including crypto. The government wants to crack down on frauds and scams, so they're setting up a national fraud squad to tackle related crime. The reported value of UK cryptocurrency fraud climbed 32% to £226 million in the year ending in September of 2022. Now, the UK wants to clamp down on crypto use for crime. They've been debating the Economic Crime and Corporate Transparency Bill. That bill is expected to help law enforcement agencies seize and freeze crypto for crime. Police have officers stationed nationwide to help investigate these crimes. The UK is a major market for crypto. The government's proposed regulations will have a significant impact on the industry. So if the government strikes the right balance between regulation and innovation, it will help legitimize the crypto industry, thereby attracting more investment. However, if the regulations are too restrictive, they will stifle all that innovation and growth. It is clear that the government is taking a serious look at the crypto industry and is considering how to regulate it in a way that protects consumers and promotes innovation. The French Senate's Economics Committee has proposed to allow crypto influencers to promote the products of registered crypto companies. This is a departure from the approach taken by the National Assembly. We covered it here in March when they voted to effectively ban crypto ads by social media stars. The Senate's amendment is set to be discussed in the Senate plenary next week. It would allow crypto companies to pay for publicity via influencers. That is, if they are registered with or have a license from regulators. This would align the bill with the existing French Consumer Code. The National Assembly previously took a harder line. They said influencers should only be able to promote products from crypto companies with a Financial Markets Authority license. Now, here's the thing. Nobody has that license. By contrast, dozens of companies, including Binance, Bitstamp, and eToro, have registered. That registration confirms that they meet money laundering and governance norms. Now, normally this bill would have to be agreed upon by both the Senate and the Assembly to pass into law. One industry group has previously said that the Assembly's position could harm the country's aspiration to be a crypto hub. We'll talk about that in a bit. They tweeted on Wednesday that the committee's stance was encouraging. The Senate's amendment is seen as a positive development for the crypto industry in France, in part because it will allow crypto companies to reach a wider audience through influencer marketing. This could lead to increased adoption of crypto. The amendment is also likely to boost investor confidence in the crypto sector. It shows that regulators are taking a more supportive approach to crypto, which could encourage more people to invest in cryptocurrencies. Overall, the Senate's amendment is a positive development for the industry. It is likely to lead to increased investment, innovation, and adoption of crypto. In addition to the news from France, there is also positive news from the European crypto market. A new survey was produced by Greenfield Capital. It names Lisbon, Berlin, and Paris on a list of the world's top 10 crypto hubs. Lisbon led the way. Half the survey's respondents listed the Portuguese capital when asked to name 3 hubs. Jessica Samadi is a co-founder and partner at Greenfield. They said that early-stage crypto outfits are, quote, looking at the world in terms of, what are the risks in my venture? There is a clear indication that startups are now favoring Europe and, in particular, Lisbon. The results come amid significant concerns over the viability of the United States as a base for crypto firms, as regulators statewide pile on the pressure both on startups and their banking partners. 70% of the respondents identified regulation as the most significant development to watch for the crypto sector over this year. According to the survey, the markets and crypto assets regulatory regime and the clarity that it offers are seen by founders as advantages rather than an obstacle. Greenfield has raised 3 funds since 2018. The most recent was a $160 million fund that closed in November of 2021. Samadi said that the number of European investments made in that latest fund has increased massively compared to the previous funds, accounting for up to 70% of its bets. Now, of course, I see that news out of France and Europe as a positive thing for the crypto market. It tells me that their regulators are taking a more supportive approach to crypto. That could encourage more investment and innovation in the sector. A cryptocurrency YouTuber has been served a lawsuit through a tweet. Tom Nash is one of 10 defendants named in a class action lawsuit against influencers allegedly promoting FTX without disclosing their compensation. The lawsuit claims that the influencers received millions of dollars in payments from FTX to promote the exchange on their social media channels. However, they did not disclose these payments to their followers. That violates federal securities laws. The court's decision to allow the lawsuit to be served through the tweet is a significant development. It sets a precedent for other courts to follow, which will make it easier for plaintiffs to serve defendants in cryptocurrency cases. The lawsuit against Nash and the other influencers is just one of several legal challenges facing FTX. The exchange is also facing a lawsuit from the US SEC. That suit alleges that FTX violated securities laws by offering unregistered securities to investors. I tell you what, though, I should have been a lawyer. The lawyers and consulting firms involved in FTX's bankruptcy proceedings are set to cash in a total of $103 million over the first quarter of this year. Those from March were even higher than January and February's figures of $34.2 million and $32.5 million, respectively. Sullivan and Cromwell again walked away with the biggest paycheck. They took in $14.1 million in fees and expenses for March, bringing that to a total of $44.4 million over the first quarter. Partners at the firm took home $2,165 per hour. Paralegals and legal analysts were paid $425 and $595 per hour for their contributions. Consulting firm Alvarez & Marsal came in next. It invoiced over $13.8 million in March for tens of thousands of hours it collectively committed to avoidance actions, financial analysis, and accounting procedures. It was the third consecutive billing over $10 million for the firm. They've served as FTX's restructuring advisor since SBF's former empire filed for bankruptcy on November 11th. Fellow law firms Quinn Emanuel Urquhart and Sullivan and Landis Rath and Cobb respectively billed FTX $3.19 million and $644,000 in March. They had respective totals of $7.3 million and $1.9 million over the first quarter. As Landis Rath and Cobb serve as FTX's special counsel, that firm spent most of its hours in the courtroom attending court hearings and undergoing litigation procedures. Over 180 lawyers from Sullivan and Cromwell, Quinn Emanuel Urquhart and Sullivan, and Landis Rath and Cobb have been assigned to work on the case. Forensics consulting firm Alex Partners invoiced its largest bill at $4.51 million in March. totaling $10.2 million over the quarter. This is for the firm's work in analyzing decentralized finance products and tokens in FTX's possession. Despite a severely troubled 6 months, FTX has not put a nail in the coffin. With $7.3 billion in assets recovered, FTX's legal team is eyeing a potential reboot of the trading platform as early as April of next year. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.